Hello, and welcome to the Invest with Carl podcast. I'm Jamie Eppenberg, your host and a member of the Carl team. We are chatting today with Vittorio Manente from Alpha Growth Capital, and we will ask our usual first set of questions, which is what the strategy is all about, why Vittorio started it and why he invests in it, and some fund history and what's important for you to know about this strategy as an investor. So let's get started. We are Carl, digitally offering quantitative hedge fund strategies as fund of funds, packaged and data-driven delivery to accredited investors. Next Alpha is an offering from Carl as Matterhorn. I'll introduce Vittorio. Vittorio Manente has worked as a program manager and strategy analyst for the last 16 years within the automotive and oil and gas sectors. Vittorio became passionate about finance in the summer of 2011 when he saw opportunities to profit after a market meltdown. Vittorio was not satisfied by the performances of financial products available for retail investors. That should be you, listeners. He decided to create his own. And in 2017, Vittorio launched Next Alpha, a quantitative macro strategy to deliver consistent returns independently of the market direction. He then founded Alpha Growth Capital in 2019. Hi, Vittorio. It's great chatting with you today. Good to see you.
The pleasure is mine. Thank you for having me.
So to kick us off, tell us, we always ask, what has made Next Alpha so successful so far, and why do you keep it in your portfolio, aside that you manage it?
In my opinion, really, the price dynamic is not as stochastic as it might look like in appearance. And we actually believe that there is always a mechanism that is driving the price actions. So what we do at Alpha Growth Capital is to define algorithm to understand this price action and basically try to understand where the market might move in the future based on what the market is doing today. So basically, we build algorithms that are defining these price actions, and then we take these algorithms and we apply to uncorrelated asset classes. And once we have done that, we put it in our umbrella strategy that is called Next Alpha. And so far, we have accepted the Next Alpha back in November 2017. And in the last 4 years, the approach has worked out quite well, I would say. We have a strategy that is loosely correlated with the market. We have only 19% correlation with the S&P 500. And in the last 4 years, we have delivered more than 22% annualized return.
So if I understand correctly, you have algorithms and sort of, I'm simplifying, I know, but rule sets that allow you to project price differentiations that you're, saying are going to happen in the market, and you look to take advantage of those. Is that correct?
Yeah, that's correct. Basically, we look at how the price is moving now, and based on what the market does now, through statistics, we can kind of say what it might do tomorrow.
Right. So it is a quantitative strategy, right? So you're taking in a lot of data to make the decision about where a particular security is headed, right? Is
that's correct? Yes.
Okay. So with that, are you only in the S&P, or what sectors are you in overall?
Now, we invest in a variety of sectors. So basically, we have a modular approach. So we have the same type of algorithm, and we apply the same algorithm to different asset classes. So we invest in equities, so the S&P 500, the Dow Jones, or the Nasdaq. We also invest in agricultural commodities, bonds futures, and volatility products.
Oh, wow. So you have quite a few sectors that you participate in. I heard commodities, agriculture commodities, bonds, and then what was the last one? Growth sectors?
No, volatility products.
Volatility products. Oh, I heard that way wrong. Okay. Wow. I don't think we have a strategy that plays across so many sectors. So that's quite a bit. It offers a great That's a great diversification opportunity right there. But let's keep the chat going. So obviously it's performed well in the last couple of years. As Next Alpha, Next Alpha is the strategy that Matterhorn is based on, the Carl Matterhorn strategy is based on. So as Next Alpha management and now Matterhorn, you really care about understanding the mechanisms that drive that price action. Was that the plan from the beginning for Next Alpha, and has it changed since you launched the strategy, or is it fairly consistent?
I would say that in the last 4 years, the approach that we have taken hasn't changed. We always have been investing since its inception in uncorrelated asset classes, and we have always used algorithms to understand in which asset class we need to be invested in. What has changed over time is the way in which we take investment decisions. Okay, so the algorithm is the part that's changed over time. I would say it's improved, because at the beginning, when we started, we were using a momentum-based approach, and then to reduce the drawdown of the strategy without penalizing the returns, what we did was to complement this approach with some kind of smart exit signals. And we have kept the strategy pretty consistent for a couple of years. And then in September 2019, we changed algorithm and we start to implement machine learning, because according to the research that we did, what we saw was that machine learning was enabling us to increase the return while at the same time to reduce the drawdown. And there was a significant change between these two approaches, machine learning and momentum-based. So we have been using machine learning for a year until September, October 2020. And around that time, we transitioned into predictive analytics. And we decided to use predictive analytics instead because we could get the same type of returns that we get with machine learning, but at a much reduced volatility and the drawdown. And predictive analytics is pretty fascinating in my opinion, because we basically look at the volatility of the market, and based on the market volatility, we can then decide with this approach in which asset class we need to be invested in, how much money to allocate to each of the asset classes, and when to enter and exit the trade, both intraday as well as on a just longer time horizon.
I mean, we often see machine learning when it comes into a strategy to help on the risk side, which you've said it did help in making better drawdown decisions and exit decisions. But it sounds like your machine learning, you were able to enhance across the board, the strategy itself, the drawdown, exit, decisioning, all of it. Did I hear it right?
Yeah, that's correct. So basically, the reason why we transition from machine learning to predictive analytics is because machine learning has limitations. Machine learning is basically like a human. We know, I mean, the algorithm knows as much as long as a situation has presented itself in the past. So if we're facing a completely new different situation, machine learning can be as good as a human, so it can make mistakes. Correct? Okay. So once we have realized that, fortunately, we didn't realize it the hard way. We just discovered it just the easy way, so to say. Once we realize the limitations, then we'll switch into this other approach that allows us just to get out of a trade intraday if the price actions moves against the security we're holding. And this was not possible. It wasn't possible to do that with machine learning.
I see. So you actually went into machine learning and then out of it into the predictive analytics space.
That's correct. Yes.
Which is giving you, it doesn't have such a learning curve as the ML does, right? So
exactly. Yes.
Okay. Very interesting. We're learning more and more about quantitative strategies as we add more and more different types that have gone through phases of use of algorithms and data and machine learning and lots of different configurations of quantitative strategies, I would say. All use a lot of data, of course. I think that's the biggest underlying consistency, right? It takes in more data than a human can process, for sure. So all wonderful. Obviously, a lot of focus on your fund, and that's done well over the past few years. You guys have made some, sounds like really great adjustments, even though it was performing well originally, but some great adjustments. Everyone likes to hear the risk side, and we'll have a whole episode. We'll chat just about risk another time as well. Because that's a big focus for a quality hedge fund, right? You want to make sure the risk side is actually functioning very well. That's against the stereotype of hedge funds. But during the past few years have brought, obviously, the investments digital revolution, using technology to make investments available to more people. And we have a lot of players in that space, and Carl's a new player in that space. What do you think about the changes overall with the investments, particularly hedge funds, quantitative hedge funds? You're bringing on retail level investors now. How does that change at all the way you think about your strategy or moving forward with the strategy?
Not really. I think that the evolution that we have had in the last few years has been very beneficial for investors. And this is because, like, platform like I don't know, Robinhood or eToro, what they managed to do was to lower the barrier of entry for retail investors. So now, I mean, everybody can access to complex strategies, complex products with pretty much zero fees and very low, like startup capital. I mean, you can open an account with €100, with $100, so to say. But the issue that I see with this platform is all of them made look like investing like a magic box where everybody can get rich overnight. But the issue here is investing is not as simple as you basically look into social media, because investing, in my opinion, it's like a job. You really need to know what you are doing to just basically to make money at the end of the day, so to say. And when you're basically combining this new technology with good money managers, then at the end, you lower the barrier of entry for retail or professional clients. At the same time, you have a professional person that is managing the money on the client behalf. And at the end, the person that wins is the investor, because you have like quality strategy you can basically profit from quality strategies, and at the same time, you don't need to invest millions, because just the money you have, you can put it in the market, and just people, they can manage this on your behalf.
Yeah, I think we've seen some of that. You're talking about the barriers to entry are certainly less. I will say that for hedge funds and we're one of the only retail hedge funds on the market. It is a $20,000 minimum investment. However, that can be diversified in up to 10 funds, which I think we have 7 on the site right now. So that's a huge shift, right, from having to invest millions. And we do have fees as well. So we're not a zero fee platform, but that's because we are sophisticated investments. I think what's important in what you just talked about is that you do get a professional manager who this is their job, like every day, right? And most of us don't have time. Like, we're not professional investors, right? We have money and we want to be able to have that money grow, where banking products don't let us do that anymore, right? You're not going to get that from your bank anymore, at least not right now. This is an opportunity to do that while really being able to manage your risk side, like really being able to look at the risk controls within these strategies. So certainly we see that, and we see a lot of people. Actually, I'm one of them. I don't like just going out into the stock market and having to choose companies to invest in. I don't have the time or space to do the research for that. So I really enjoy having strategy managers who are, and you have tons of machines behind you doing the research for us. So thank you for that. But it sounds like it won't change what you do with your strategy in particular. It's just that you're able to help more people. Is that?
That's correct, exactly. Because what we try to do within the strategy is not to achieve as high return as possible. So what we're constantly doing when we manage the strategy or we try to come up with better algorithms is to reduce the drawdown and reduce the volatility of the strategy. So that's our primary focus. And this is because on paper, a lot of people, when they're looking, for instance, the screen, and on paper, they see that they can get very high return, but at the same time, they read 30 to 40% drawdown. So a lot of people on paper, they say, okay, I can invest my money in this type of a strategy. But then what actually happens when there is a market meltdown or just your strategy is just crashing, people tend to sell when the market goes down or when the strategy goes down, and then they buy when the strategy is at all-time high. So what actually the investors are doing is to sell the low and buy the high, which it's basically the opposite. And what we constantly doing over here is trying to define our strategy or tailor our strategy to get an acceptable maximum drawdown, which in our experience is in the range of 10 to 15% measured with daily data, not on a monthly basis, without penalizing the return. The returns get acceptable reward. So that's basically how I spend my days, try to figure it out how to do that.
I mean, that's, and those are, I mean, if, you said it quite perfectly for a Carl hedge fund. Those are the tenets of what we require in a fund to enter the platform is yes, we want to see your returns. You should have intended returns of meeting or beating market indexes. And then you have to have the risk controls to take the edge off of the downturns. You should not have downturns as deep or as long as the market, right? That's correct. And in general, we call those intended risk controls, meaning you have controls that are meant to do that. It doesn't always work 100% of the time, but if it works, at least a majority of the time, you're going to perform better, right? Overall, because you're saving more money is working. I just want to say again, like those are the tenets of a quality hedge fund. There's a lot of not, low quality, bad quality hedge funds in the marketplace. And I think they give the rest of us a bad rap, right? for just going for crazy returns, but putting a ton of capital at risk. So much has changed and so much is the same. We have the performance and the risk controls always. We're always talking about those two sides, right? In quantitative hedge funds, Carl is enabling more investors to have more access to fund performance. So this is an interesting question. I know you said that people can get, when I asked, retail investors, and you said, well, they can get access to really complex investment strategies. I think a big part of that is that we're giving them complex investment strategies, but with the same data that they could see before, right? Like transparency is huge. And I think, they'll be able to see how, you say 22% over the past couple of years. They'll be able to go in and look at how Matterhorn did over the past couple of years. And also they can look at any period within the past 4 years, right? It's quite a different world. So with that as a background, and actually our whole conversation as a background, what do you think what is something that Matterhorn investors could feel really good about? Or said another way, what has Next Alpha and in the future Matterhorn, what do you work really hard at?
We work really hard on minimizing the drawdown and the volatility of the strategy. Okay, so in the beginning, when we started Next Alpha, we were very much focused on delivering uh, high annualized returns. All right, but then we shift our focus from delivering very high return, try to deliver very high return, into minimizing the drawdown. And that's a shift that took place like a year and a half or two after the strategy was accepted, because we have some investors, and basically I saw with my first hands that just people don't like the drawdown. People really don't like volatility, they don't like the drawdown. So now, even though we're using a quantitative strategy and we use algorithm, it's not like we have a crystal ball, but we can at least try to control these parameters by tailoring our strategy. So we really care about minimizing the drawdown and the volatility strategy as much as we can, without just penalizing our return on investment. So that's really our focus. Keep the drawdown low and do not compromise the return on investment.
Yeah, investors do have a hard time with the drawdowns. I know. I mean, I've heard, I'm one of them. I have a really hard time with it. Did you have some investors who were like constantly in touch with you?
Yes, my wife. So let me tell the story of my wife. So my wife has been the investor number 3 and number 4, right?
Yeah,
So
that's common. Yeah.
yeah, she put some money in the strategy. No, not much, but some. So every single time the market goes down or she loses, I don't know, 3-4% because of these usual drawdowns, then at night when we go to bed, all the time I listen complaining, like, why are you losing money? Caroline, it's normal that you lose money once in a while. It's only 2-3%. Look at it, you have done 25% in the last year. Then when the market goes up, no compliments or
No.
nothing, but you lose that 1.5%. You need to be more consistent. You need, yeah.
I think you've learned what we talk about firsthand a lot at Carl, which is, when you deal with, we've talked about it in the high net worth space. High net worth individuals do not like losing money. When they lose 3%, it's quite a lot of money. Right. But it's true for anybody, regardless of the amount of money you have in play. We don't like losing money.
Jokes apart, I mean, I need to say thanks to her, because if Next Alpha is where it is, it's also thanks to her, because my threshold of tolerance to drawdowns, it's much higher than, for instance, her case. So by listening what she says, I know what maybe the general public might feel. So for me, it was a way to adapt what I do to what basically more people can find acceptable.
Right. Larger expectations for sure. For sure.
Right.
Yeah. What I want to relay to our investors then, when they're looking at strategies like Matterhorn, it's important to look at the growth, right, that we've talked about today, and that it has performed fairly well. I always have to say historical returns are not indicative of future returns. So keep that in mind. At the same time, it's important to look at the risk factors within any strategy. And Matterhorn, of course, is working very hard at that. So they would want you to look at their risk factors as well. You can find those if you go to Analyze and you go to Matterhorn and you click Explore in our mobile app and you go to the info section. You'll have all of these statistics right there for you, and you can choose the time period to review them. So you can look at the average drawdown of Matterhorn. You can look at the depth of that drawdown. How big do they get? And that information is always available to you. The last 4 years will be for the strategy that Matterhorn is based on. It will be for Next Alpha. And then as the strategy grows, you will get specifically Carl Matterhorn data in there. Okay. So hopefully that helps you, investors. Obviously, it was great talking with Vittorio today. Vittorio, thank you so much for joining us. Do you have a final word for our investors?
Yes, I would like to say is the financial market is a really fascinating place where people can really grow their wealth. It can be done. It's not as easy as you see on YouTube or you see on Facebook, the key really is to have a strategy in place, a strategy you believe, a strategy you can stick to because you trust the strategy or you trust the person that manages the strategy, the manager of the strategy. And you need to learn how really to navigate through the emotions of the moment. It's not easy. It might take months or years, but if you learn how to do that, then the financial market is a great place where you can grow your wealth.
Well, Vittorio, I'm glad to have you doing that for potentially even my own portfolio in the future. I look forward to having others deal with the emotions of it, and I put my portfolio in many of your hands. So we really welcome you to the platform. It's great to have you. Welcome, Matterhorn, and we will talk to you next time about risk. Thank you so much, investors. We'll see you next time. Bye-bye.
Thank you.
Thank you for listening to the Invest with Carl podcast. The views shared on this podcast do not necessarily reflect the views of Carl. This podcast is intended for informational purposes only and is not intended to constitute and should not be deemed to be an offer to sell or a solicitation of an offer to buy any security or investment, financial advisory, legal, tax, accounting, or other professional advice. Carl funds are currently available to accredited investors with a minimum investment of $20,000. To learn more about Carl and to download the Carl app, go to investwithcarl.com.